On May 22, 2010, a programmer in Florida paid 10,000 bitcoins for 2 pizzas. Today, those pizzas cost him roughly $1 billion. Not because the pizza place knew something, not because he was careless, but because at that exact moment in history, Bitcoin had no agreed upon value. It was just numbers on a screen, lines of code that a handful of people believed might one day mean something. Fast forward 15 years, Bitcoin is trading above $100,000. Trillion-dollar asset managers own it. Countries hold it in reserve. Pension funds are buying it. And yet, if you ask 10 people what Bitcoin actually is, you'll get 10 completely different answers. Some call it digital gold. Some call it a scam. Others call it the future of money itself. But here's what almost nobody talks about. The question that actually matters is now, right now, in 2026, the moment to buy or the moment everyone finally realizes they're late? By the way, my name is Ben, and you're watching Ben Invest, where I share financial secrets and tricks for you guys. Let's start with something uncomfortable. Most people who talk about Bitcoin, whether they love it or hate it, don't actually understand how it works. And I don't mean the technical details. I mean the mechanics, the structure, the reason it exists at all. Because Bitcoin wasn't invented by a bank. It wasn't designed by a government. It was released anonymously by someone or some group calling themselves Satoshi Nakamoto in 2008, right in the middle of the financial crisis. Think about that timing for a second. The world's banking system had just collapsed. Lehman Brothers had failed. Governments were printing trillions of dollars to bail out the institutions that caused the crash. Trust in the financial system was at an all-time low. And into that chaos, someone released a 9-page document called the Bitcoin White Paper. The title? Bitcoin, a peer-to-peer electronic cash system. Not a currency, not an investment, cash. The idea was simple, almost radical in its simplicity. What if you could send money to anyone, anywhere in the world, without needing a bank, a government, or any middleman at all? What if the money itself was just math? That's Bitcoin. It's not backed by gold. It's not backed by a government. It's backed by a network of computers around the world that verify every transaction, lock it into a permanent record, and make it nearly impossible to cheat. This record is called the blockchain, and once something is written into the blockchain, it can't be erased. It can't be changed. It just is. Sounds perfect, right? Well, hold on. Here's where it gets weird. Bitcoin was designed with a hard limit. Only 21 million Bitcoins will ever exist, not 22 million, not 25 million, exactly 21 million. No one can print more. No one can inflate the supply. It's written into the code. This is the feature that Bitcoin believers love most. They call it scarcity. Digital scarcity. Gold is scarce because there's only so much of it in the ground. Dollars are not scarce because central banks can print more whenever they want. Bitcoin sits somewhere in between, rare like gold, movable like dollars. But here's the part most people miss. Those 21 million Bitcoins, they're not all available yet. As of right now, about 19.6 million have been mined. The rest won't exist until the year 2140. Yeah, 2140. Bitcoin is released slowly, on a schedule through a process called mining. Miners are people, or more accurately, companies, running massive computer farms that solve complex math problems. When they solve one, they earn new Bitcoin. But every 4 years, the reward gets cut in half. This is called the halving. In 2009, miners earned 50 Bitcoins per block. In 2012, that dropped to 25, then 12.5, then 6.25. In 2024, it dropped to 3.125, and this will keep happening every 4 years until the final Bitcoin is mined over a century from now. Why does this matter? Because the halving creates a supply shock. Less new Bitcoin enters circulation. If demand stays the same or goes up, the price tends to rise. Historically, every halving has been followed by a massive price surge. 2012 halving. Bitcoin went from $12 to over $1,000. 2016 halving. Bitcoin went from 650 T to nearly $20,000. 2020 halving. Bitcoin went from $8,000 to $69,000. We just had another halving in April 2024. You see the pattern. But patterns aren't guarantees. Let's talk about what Bitcoin actually does. Because this is where the confusion starts. Bitcoin was supposed to be cash, a way to buy things. But almost nobody uses it that way. Why? Because it's slow. A Bitcoin transaction takes about 10 minutes to confirm, sometimes longer. Visa processes thousands of transactions per second. Bitcoin processes 7, and it's expensive. During busy times, transaction fees can hit $50 or more. Imagine paying $50 to buy coffee. So if Bitcoin doesn't work well as cash, what is it? The narrative shifted. Now people call it a store of value, digital gold, something you hold because it might go up in price, something scarce, something separate from the traditional financial system. And honestly, that narrative makes more sense. Gold isn't useful because you can buy groceries with it. It's useful because it holds value across time. It doesn't corrode, it doesn't decay. It just sits there, rare, trusted. Bitcoin does the same thing, digitally. You can't hold it, you can't touch it, but you can own it. You can send it across borders in minutes. You can store millions of dollars worth of it on a USB drive. Try doing that with gold bars. But here's the irony. Gold has been trusted for thousands of years. Bitcoin has been around for 16. Gold survived empires, wars, revolutions. Bitcoin hasn't even survived 2 full economic cycles. So when people say Bitcoin is digital gold, what they're really saying is this: we think it might become gold one day. Maybe, that's the bet. Now let's talk about the part that actually moves the price: belief. Bitcoin has no earnings. It doesn't pay dividends. It doesn't produce anything. Its value is entirely based on what people are willing to pay for it. That's not a criticism, that's just how it works. The same is true for gold, by the way, and art, and baseball cards. But here's the difference. Gold has a 5,000-year track record. Bitcoin has a 16-year track record. And for most of those 16 years, it was dismissed as a joke. Then something changed. In 2020, big institutions started buying. MicroStrategy, a software company, began converting its cash reserves into Bitcoin. They now hold over 400,000 Bitcoins, worth tens of billions of dollars. Tesla bought $1.5 billion worth in 2021. El Salvador made it legal tender. And in January 2024, the U.S. Securities and Exchange Commission approved the first Bitcoin ETFs, exchange-traded funds. This was huge. For the first time, regular investors could buy Bitcoin through their brokerage accounts. No wallets, no private keys, no technical hassle, just click a button and own Bitcoin. Within weeks, these ETFs pulled in billions of dollars. BlackRock's Bitcoin ETF became one of the most successful ETF launches in history. Suddenly, Bitcoin wasn't just for tech nerds and libertarians anymore. It was for pension funds, for retirement accounts, for your parents. And when that happens, the psychology shifts. It's no longer fringe. It's no longer radical. It's just another asset. But does that make it safer? Or does it make it more vulnerable? Let's zoom out and look at the actual numbers. Bitcoin launched in 2009 at essentially zero. By 2013, it hit $1,000 for the first time. People thought it was insane. Then it crashed back to $200. In 2017, it hit $20,000. The media went wild. Everyone was talking about it. Your Uber driver was talking about it. Then it crashed to $3,000. In 2021, it hit $69,000. All-time high. Euphoria everywhere. Then it crashed to $16,000. Notice something? Every cycle, the highs get higher, and the lows get higher too. But the crashes? They're brutal. 70%, 80% drops. Wipeouts that would destroy most investors. And yet, if you bought at almost any point before 2022 and held, you're still up. That's the paradox of Bitcoin. It's wildly volatile, and it's wildly profitable. Sometimes both in the same year. Right now, in early 2026, Bitcoin is hovering above $100,000. It broke 6 figures. Some people think it's going to $500,000. Others think it's about to crash again. Who's right? Here's the uncomfortable truth. Nobody knows. Not the analysts. Not the CEOs. Not the guy on Twitter with the laser eyes. Nobody. Because Bitcoin's price isn't based on fundamentals. It's based on sentiment, on narrative, on whether enough people believe it's worth buying. And belief is fickle. Let's talk about the risks. The ones people don't like to mention. First, regulation. Governments tolerate Bitcoin right now. but tolerate isn't the same as embrace. China banned it. India tried to ban it. The US regulates it inconsistently across different states and agencies. What happens if a major government decides Bitcoin is a threat? What if they ban exchanges? What if they make it illegal to convert Bitcoin into dollars? It's happened before with gold. In 1933, the US government literally confiscated gold from citizens and made private ownership illegal. Could they do that with Bitcoin? Technically, no. You can confiscate something that lives on a decentralized network, but they can make it very, very hard to use. Second, technology risk. Bitcoin runs on cryptography, specifically an algorithm called SHA-256. Right now, that's unbreakable. But quantum computing is advancing fast, and if or when quantum computers become powerful enough, they could theoretically crack Bitcoin's encryption. Some experts say we're decades away from that. Others say we're closer than we think. If it happens, Bitcoin becomes worthless overnight. Third, competition. Bitcoin was the first cryptocurrency, but it's not the only one. Ethereum does smart contracts. Solana is faster. Stablecoins are more practical for payments. Bitcoin's main advantage is that it's the oldest, the most recognized, the most trusted. But first mover advantage doesn't last forever. Ask MySpace. Here's what makes Bitcoin different from almost every other investment. It has a community, not shareholders, not stakeholders, a community, people who believe in it with almost religious fervor. They call themselves maximalists. They believe Bitcoin will replace the dollar, the euro, the yen. They believe it's the future of money itself, and they might be right, but they also might be caught in a feedback loop, an echo chamber where everyone agrees, everyone buys, and everyone assumes the price can only go up, until it doesn't. This is the nature of speculative assets. They rise on belief, and they fall when belief cracks. The question you have to ask yourself is this: do you believe in Bitcoin because you understand it, or because everyone else seems to? There's a difference. One is conviction, the other is FOMO, fear of missing out, and FOMO is how people lose money. Let me tell you a story. In 2017, a guy I knew sold his car to buy Bitcoin at $18,000. He was convinced it would hit $100,000 by the end of the year. It didn't. It crashed to $3,000. He held on, hoping it would recover. It did. Years later, but by then, he'd already sold at a loss because he needed the money, because he'd invested more than he could afford to lose. That's the real risk, not the technology, not the regulation. It's you, your emotions, your fear, your greed. Bitcoin doesn't care if you panic sell. It just keeps running. So let's get to the question everyone's asking. Is now the best time to buy? Here's what we know. Bitcoin is at an all-time high. Institutional adoption is real. ETFs are live. The halving just happened. Historically, that's bullish. But history doesn't repeat. It rhymes. Every previous cycle had a blow-off top. A moment where the price went parabolic, everyone piled in, and then it crashed. Are we in that phase now? Or are we just getting started? Some analysts say Bitcoin could hit $200,000 this cycle. Others say $500,000. A few even say $1 million. But those predictions are based on models. Models that assume the future looks like the past. What if it doesn't? What if this time, instead of crashing, Bitcoin just stalls? What if it trades sideways for 5 years while inflation eats away at your purchasing power? What if the next big thing isn't Bitcoin at all? These are uncomfortable questions, but they're the right questions because the goal isn't to own Bitcoin. The goal is to build wealth. And sometimes building wealth means saying no. Saying no to hype. Saying no to narratives. Saying no to assets you don't fully understand. Let me give you a framework. Not advice. A framework. If you're thinking about buying Bitcoin, ask yourself 3 things. 1. Can you afford to lose this money? Not what it hurt. Can you literally afford to watch it go to zero and still be okay? If the answer is no, don't buy. 2. Do you understand why you're buying? Are you buying because you believe in the technology? Because you think fiat currency is doomed? Because you want exposure to a non-correlated asset? Or are you buying because the price is going up and you don't want to miss out? Be honest. 3. What's your exit plan? Are you holding for 10 years no matter what? Are you selling at a certain price? Are you taking profits along the way? Most people don't have an exit plan. They just buy and hope. Hope isn't a strategy. Here's the truth about Bitcoin. It could go to $500,000. It could go to zero. Both are possible. The people who win are the ones who size their position correctly, who don't bet the farm, who don't panic when it drops 30% in a week, because it will drop 30% in a week. Maybe next month, maybe next year. That's what it does. If you can't handle that, if you'll lose sleep over it, if you'll check the price every hour, you shouldn't own it. Not because Bitcoin is bad, but because it's not right for you, and that's okay. Now let's talk about the bigger picture. Bitcoin exists because people don't trust the system. They don't trust central banks printing money. They don't trust governments managing inflation. They don't trust the institutions that caused the 2008 crash and got bailed out while regular people lost their homes. Bitcoin is a protest against centralized control, against debasement, against the idea that money should be managed by a small group of people in a room. And that protest resonates, especially now. When inflation is high, when trust in institutions is low, when people feel like the game is rigged, Bitcoin offers an alternative, a way out, a parallel system. But here's the paradox. The more successful Bitcoin becomes, the more it gets absorbed into the system it was designed to replace. BlackRock owns Bitcoin now. Fidelity owns Bitcoin. Banks are offering Bitcoin services. Is that adoption or co-option? Some people say it doesn't matter. As long as Bitcoin remains decentralized, as long as no single entity controls it, the mission is intact. Others say the mission is already lost, that Bitcoin has become just another asset for Wall Street to trade. Both sides have a point, and the tension between them is what makes Bitcoin so fascinating. It's not just an investment, it's a battle over what money should be, who should control it, and whether ordinary people can truly own something outside the system. That battle isn't over, it's just beginning. Here's something almost nobody talks about: the environmental cost. Bitcoin mining uses an enormous amount of energy, as much electricity as entire countries, Argentina, the Netherlands. Why? Because mining is competitive. The more computing power you throw at it, the better your chances of earning Bitcoin. So miners build giant warehouses full of machines running 24/7, consuming electricity at a staggering rate. Most of that electricity comes from fossil fuels. Now, Bitcoin advocates will tell you mining is increasingly powered by renewable energy, and in some places, that's true. But not everywhere, and even renewable energy has an opportunity cost. Solar panels and wind turbines powering Bitcoin farms could be powering homes instead. Is that worth it? Depends on what you think Bitcoin is. If it's a revolutionary financial system, maybe yes. If it's a speculative asset that people trade for profit, maybe no. The honest answer is we don't know yet, because Bitcoin's final form hasn't been decided. It's still evolving, still being defined, still fighting for legitimacy. And that's the risk and the opportunity. So where does that leave us? Bitcoin is worth over $100,000. It's held by institutions, it's traded by millions. It's survived crashes, bans, and countless obituaries. It's also volatile, unregulated, and completely untested in a real financial crisis. The 2008 crash happened before Bitcoin existed. The COVID crash was met with unlimited money printing, which pushed Bitcoin higher. What happens in the next real crisis? When governments stop printing, when liquidity dries up, when people need cash, not speculative assets? We don't know. And that's the point. Bitcoin is an experiment, a live global trillion-dollar experiment. You're not investing in a company. You're not buying a bond. You're betting on an idea. The idea that money can exist outside government control, that scarcity matters, that code can replace trust. Maybe that idea wins. Maybe it changes the world. Or maybe, 20 years from now, we look back at Bitcoin the way we look at Pets.com, a fascinating moment, a glimpse of the future. But not the future itself. I don't know which one it is, and neither do you. The only question that matters is this: knowing all of that, knowing the risks, the volatility, the uncertainty, are you still willing to buy?